Okay, so let's move on to talking about enterprise value again. And this will be, I think, fairly simple for you to follow. And again, I've got these slides up online for you, and I've also sent them across to you by WhatsApp. But remember that this enterprise value that we've estimated is the estimated value of the company. So when we think of enterprise value, we know that, because we dealt with this earlier in the term, that enterprise value is the market value of the common plus the market value of the preferred plus the market value of debt minus cash. And that's one of the equational structures. But we also know that when we estimate a value for a company, the value we have estimated is the enterprise value. Or when we transact for the company, let's assume that we've got Casto Enterprises, and Casto Enterprises has a VC offering out and has accepted a $5 million equity valuation or equity infusion based upon a $30 million valuation. Well, they got $5 million of common equity maybe, but it was based on a $30 million valuation. And in that case, that valuation is synonymous with its estimated value, its enterprise value, okay? So if we can estimate that value, and if we then know that it also equals the market value of the common plus market value of the preferred plus market value of debt minus cash, we can then use the known here to solve for what might be one of these that are unknowns. Well, cash should not be an unknown. That ought to be pretty easily found, right? It's on the balance sheet. Market value of debt should not be a mystery to you guys. That should not be an unknown. The market value of our equity, common and preferred, that might be an unknown because that's going to be more of a market or a transaction-based relationship. So if we know what the enterprise value is because we've estimated it or because we've observed it in a transaction, we can find the parts of the other equation that we don't necessarily know. To do that, we're going to rearrange the equation to solve for the market value of the firm's equity shares. To do that, we've got to have an understanding of the relationship of the firm's equity shares. So if a company doesn't have any preferred, then its common is very simple, and its common is its common. We don't have to go any further with that element. But what if a company's got both common equity and preferred equity? And we know they almost certainly have different values, right? One of them has a built-in dividend that's substantial. The other doesn't have a built-in dividend. They have different liquidation preferences. They have different voting rights. I mean, they are different equity instruments. So we have to have some understanding of how they relate. And most often that's going to be a conversion factor. You probably realize that most of the time, preferred shares can be converted at some point in time into common shares based upon a ratio of some kind, something like 2-to-1 or 4-to-1. And if it's a 4-to-1 ratio, that means for 4 shares of preferred, I can exchange them for 1 share of common. Okay. So we need to understand that relationship. We then need to know something about the common shares outstanding. We need to know something about the number of preferred shares outstanding as well. We can then solve for the market value of the common, and we can aggregate it and we can find a per share price on it. Let's look at an example for this. So we'll go back to Marijuana, and we noted that Marijuana had a 146.002. I'm just going to call it 146 enterprise value. We know that its preferred shares are convertible to common shares at a 2-to-1 ratio. We know it has 55,700,000 shares of common outstanding. So 55.7 if we're dividing this into millions to keep it on the scale of our financial statements. We know that it's got 58.73 million or 58.733 in market value of debt, 10.933 in cash on the balance sheet. So again, we're going to now take that enterprise value, and we're going to think about the shares of common, but we also have to think about the shares of preferred. So in this case, there's 4.3 in preferred shares outstanding, so 4.3 million shares of preferred outstanding. And if that is convertible 2-to-1, that means for every share of preferred, there's half a share of common you can convert it to. So we simply take that 4.3 and divide it by 2 in this case. Or if it was 4-to-1, we would divide it by 4. So we get the equivalent number of common shares, or in this case, 0.15. The total of those then become the total equity shares, where we're using common and converted preferred. You follow me so far? Any question here? So you got to think about the ratio. And so what we're trying to do is, knowing that we have common separate from preferred, we're going to say if they were converted, how many common would that equate to? And then we can use that number, and we're going to work back to not only a value per share of common, but a value per share of preferred as well. Okay.
So how did you get the 2.15?
It was given.
Did you divide? Okay.
So when preferred shares are issued, Martin, if they're convertible, in the prospectus that governs the shares, it tells us about their convertibility. It tells us when they can be converted, under what grounds they can be converted, and at what conversion ratio they have. So this isn't something we would calculate. This would have to be given.
Okay, thank you.
Yeah, I don't know how you would calculate it otherwise. Okay.
Yeah.
Well, we've still got the debt, and we've still got the cash here. Let me make a comment about cash for a moment. In practical terms, we know that cash is part of the enterprise value equation, because if we come in and acquire this company, the moment we do so, let's say we spent $146 million on the company and it's got almost $11 million in cash. Well, we give $146 million of our dollars, but we get the 11, so we kind of can net those out. So did it really cost us 146? Well, no, it cost us 146 minus 11, right? So that's 135 is the actual out-of-pocket cash cost once we've netted that cash on the balance sheet out. And so that's why cash is part of the enterprise value equation. But if we utilize all the company's cash, does that give a company a problem? Would we ever spend all of the company's cash? Not if the company has payroll that's got to be paid the next day, or any other bill that's got to be paid in the next 30, 60, 90 days. If you take all of its cash off of the balance sheet, then you're removing from it the lubrication that keeps its cogs moving, and you destroy the company. So in textbook and theoretical terms, you would always subtract the cash that's on the balance sheet to get to this number. But in practical terms, you would only subtract the excess cash, not all of the cash. Now, for the sake of the problem sets and such that we'll do, you're going to use the equation just as it's written, because you don't have the ability to necessarily know what is excess cash and what is not. But in practical terms, it would only be subtracting out excess cash. So we know that we came up with 57.85 equivalent shares of common stock. So now what do? Well, we know that enterprise value now equals the market value of all the equity plus the debt minus cash. We're going to rearrange this so that we say the market value of the equity is equal to the enterprise value minus the market value of the debt plus the cash. Here in the case of Mira Dravana, enterprise value 146, debt at 58.77, cash at 10.93, leaves us with market value of all of its equity of 98.165. That's not just common equity, though. That's common equity and preferred equity combined, right? Because of how we use the equation here. So we know the market value of the common and the market value of the preferred is the market value of all the equity, and we simply aggregated those. But we also came up with an equivalent number of shares if we had converted all the preferred to common. So we have a number that we can divide that by to get to a per share value. So as we go a little bit further then, we can take the 98.165. We know that that's all of the value of equity, and we also know that we have all of the equity shares on an equivalent basis of 57.85, which means we've got $1.69, almost $1.70 per share, price per share, or value per share rather, of common stock. $1.70 value per share of common stock. Does it make sense how I got there? Any question about that? For most people, you've got to look at this a time or two, maybe even do an example or two of them for it to make sense to you. Obviously, I'm giving you an example here. I'll give you another example when I kind of retrace some of these steps a little bit on Wednesday. Okay? But you can run this for yourself as well. Well, that's per common because we had equivalent common shares. So we know $1, let's call $1.70 per share common. How do we find the total value of the common then? Well, we take that $1.70 times the 55.7 million shares outstanding, and we get 94.5167. That is the dollar value, or the equivalent value on a 1 million scale, of course, of the company's common shares. So we found the common price or value per share. We multiplied it by the shares outstanding. That's the total aggregate value of the common. Let's do the same kind of thing now for preferred. We're going to take that same 170 and we're now going to divide it by 2. Remember, we did the same thing when we found the equivalent shares of the preferred, such that we've got 0.84, let's call it 85 cents per share of preferred stock. We can now take that 85 cents times the 4.3 million actual preferred shares outstanding. It takes us to a preferred share total value of 3.64. And we can add then the total value of the common to the total value of the preferred, and it gives us the total value of equity of 98.165, which is exactly what we calculated to begin with. I always do this last step, by the way. Why would I do that? By the way, this should be a plus, not a equal sign. So I'm sorry, one of you tried to answer. Why would I go and do this when I already had calculated it up here?
To check if you did it good.
Yeah, it's a check digit, right? Because Alex, you've seen sometimes I don't do good. Sometimes I screw it up and I'd rather not, right?
Yep.
So that's interesting to us. We now have taken the enterprise value and substituted for it the company's estimated value or valuation. We've then run that through this equational form, knowing the market value of the debt, knowing the value of the cash, and we've brought this down to a price per share of both common stock and preferred stock. That's useful to us. How would Demoteran think about this? Remember, and we'll go back and look at the spreadsheet for just a second. Remember that we've got $1.70 of common in value, but we've got 4 1/8 in price. What would Demoteran say about it?
Me?
Talk now.
So remember in Demoteran's early videos we watched a couple of months ago, he talked about his valuation of, I think it was Uber, and he talked about his valuation of Apple and said that, you know, at the way he valued them, he was not at all interested in the shares of that company. He would never buy it at these prices. The market sets a price. We, however, have calculated a value. And when the value based upon its cash flows, its multiples, etc., is less than what we can buy it for, are you going to buy that stock? No, no. If its value is less than what we're being charged, we don't want any part of that. In fact, maybe if we think the market's going to correct and bring the price down to its value, maybe we'll sell it short, right? So when Demoteran talked about price and value and talked about how he considered Apple or maybe it was Tesla or Uber, I can't remember which one he was talking about in this respect, saying that he didn't want to be part of them, this is what he was talking about. He did this kind of an assessment to bring it to the point of, did it make sense at its current market prices? Markets value, markets price instruments, but analytics can disclose or reveal their value. And then you look at, is the value and the price similar, or could it have been just the opposite? Could this have had a value of $5 a share, but a price of 4 1/8? In which case, if it's undervalued, of course we're interested in buying it. Does that make sense? So let's look at something else here, and this is going to go back to the conversation we had about that multiple a minute ago. I'm going to come back to Mira Dravana. And remember, we have $1.70 and we have 85 cents. Okay? So we said this 9.25 multiple seemed out of whack to us. At least I said that. I didn't use it. It didn't bring about a valuation that I could believe. And I'm going to tell you that is because the enterprise value based upon these prices was overvalued. What happens to this multiple when I take an input our computed value per share instead of the price per share? Well, let's see. This was $1.69 and this was 85 cents. Look at what happens to my multiple. It comes much more into line with that 4.25. Now, this is a little bit of circular logic, to be perfectly honest with you, because I got the 146 in enterprise value using the 4.25 multiple, right? But I didn't only get it using the 4.25 enterprise value multiple. I got it also in the APV model. Oh, I just changed some of the numbers that changed these here, excuse me. So you can't pay attention to this because it threw off the whack and everything when I did this. But we find that number elsewhere as well. So before we did that, let's come back. I think this will take us back to our numbers. Yeah. So we're at about 150 here, right? In other valuation models, and 146, 147, 150, we're in a pretty tight range. So I didn't only take that enterprise value by having used the 4.25 multiple, but knowing what my enterprise value should be, I can come back in here and having brought this down to dollars per share, 1.7 and 0.85, and I get pretty close to justifying that or understanding that how plausible that 4.25 multiple is. Any questions about that? So I have to tell you, this kind of entertaining watching you guys sometimes, because I get to see the look on your face from things that are happening external to this conversation. I don't necessarily know what they are. Brandon's pretty expressive with some of them, as is Jaden. I think that's got to do with Jaden's wife. Okay, so let's take this one step further.
I just have a question, because
Yeah.
you said that so if the value we have of the equity is lower than the price, then we shouldn't be interested in the stock. But isn't the case most of the time that the value is lower than the price for good companies?
No, I don't think it is necessarily the case. I mean, it can be, but not necessarily. No. In fact, if you think about the concept of under and overvalued in the market, this kind of a analysis is what helps us reveal whether or not a stock is under or overvalued. Now, it might also be under or overvalued compared to its peers when adjusted for their capital structure and the number of shares outstanding. But that wouldn't be altogether different than using a market comp and multiples, right? Because we take into account its peers. Any other questions? So let's extend this one step further, and let's now talk about Goodwill. What is Goodwill? I'm not talking about the Salvation Army charitable-like organization. What's Goodwill? Well, let's assume for a minute that
the premium paid.
It's a premium I paid, right? And a premium over what, though? Well, it's a premium over the assets and the balance sheet relationship. So let's examine that for a moment, and it'll help the concept of goodwill come into much sharper focus for you. So here we've already identified that the equity that we just calculated here was 98.165. And we took that to an equity per share and such, but we're reading it just right back now just to equity. Well, that equity is synonymous with owner's equity on the balance sheet. Synonymous with owner's equity. And now knowing that, we can use a balance sheet equation, sometimes referred to as the BSE, to think about how these items line up together. And so we can think about assets, liabilities, and owner's equity. I know that I've got here 98.165 of owner's equity because I calculated it, okay? I also know what the value of my liabilities are. How do I know the value of my liabilities? Well, let's look at them. So current liabilities, can we take the book value of current liabilities as though that is also the market value? Sure, because these accounts payable are going to pay us within the next 90 days, 60 days, whatever it is. They're not going to see any significant degradation. Oh, there might be some allowance for doubtfuls or people that don't pay and such. But our current liabilities, we can pretty quickly accept them at face value, if you will. Now, we know that's not the case for debt. We know for debt that we're going to actually come up with the market value of the debt. And we've done this many times now, but we've got a market value of debt here of 58.733. And so we see what's going on. Okay, this makes sense to us. I want to make sure that I bring these numbers back in to where they were. This was 4 1/4. Excuse me, no, this was 4 1/8. And this was 2 1/2. So the market value of our debt is 58.733. So if I can put 58.733 in here for liabilities, 98.165 for owner's equity, then those two together ought to equal the assets, right? But the assets of the company are both tangible assets and intangible assets. And we're going to think of those as tangible assets or assets on the balance sheet and goodwill, which may or may not be on the balance sheet already. To talk about that, we need to discuss something referred to as mark-to-market accounting. Do any of you know mark-to-market accounting principles or accounting rules? So I don't want to go into too much detail on this because it's a uniquely accounting concept, but it affects us as financiers. So mark-to-market, and I'll link an article that you might be interested in reading about mark-to-market. Mark-to-market allows a company to recognize changes in value of items that were on the balance sheet. So let's look at this company's balance sheet for just a minute. We have real estate in here, and at the end of 2019, the real estate was in here at 20.311, right? And we know that that is a depreciated value, but what you probably don't realize is companies have the opportunity to look at their assets that can be valued and change that value on the balance sheet. So let's assume that we had come up with real estate at 16.13 from last year. We bought more real estate and we depreciated what we had, and such that a depreciated value of our real estate, let's say, was 20.311. But we also knew that in the marketplace, that real estate would sell for $30 million. I mean, that kind of an issue, that's not necessarily unrealistic, right? If this depreciated value had never been marked to the market, it would be its original purchase prices minus its accumulated depreciation, right? And that would be its depreciated value on the balance sheet. But if the company has marked the asset to the market value, it's allowed to change its balance sheet value to its current market value. And if that increases, then effectively what we're doing is we're adding additional retained earnings. Let me show you how that works. So let me make an assumption for a minute here that this 20.311 book value of real estate actually had a market value of 30. So I'm just going to change this to 30. And notice when I do that, that it changed the total assets on the left-hand side of the balance sheet. But it didn't change the liabilities and owner's equity on the right-hand side, right? So I'm now out of balance. I'm out of balance at about, it's 8 point something. Let me take a look at that real quick. I'm going to need to know that number. 168 0.073 minus 177.762. So I'm out of balance 9.68, 9.7. Okay. Well, what would have to change on the right-hand side of the balance sheet for this to come back into line? Just because we showed the increase in market value of our real estate, does it change any of our current liabilities?
No.
No, no. Does it change any of our current or long-term debt? Doesn't change the money people paid in preferred stock or common stock either, does it? What would it do? Well, the change from that 20 point whatever it was to 30 would be recognized over here on the income statement as additional income against which there was no expense. What will that change over here? Yeah, change retained earnings. So let's add that 9.689 to my retained earnings. I'm back in balance. Okay, that's tantamount. In fact, I would have gotten there. Let me undo that for a second. Let me go ahead and I'm just going to increase this private equity income because I don't want to create another column or another row. If I add to this, let's say this was private equity and real estate income. But you'll notice that increasing the revenue brought this closer into line. And the reason it didn't bring it completely into line is because the amount that I increased it by here didn't account for taxes when it got over here. So mark to market allows us to recognize that for many companies, the value of the assets on the balance sheet is their market value, not just their book value, if they have marked them to the market. And if a company increases the value of their assets on the balance sheet by marking them to or adjusting them to the market value, it's tantamount to increasing their profit. Well, when we did this, when we changed this number over here to it was about 11, that increased the operating income. Would that then also increase EBIT? Or rather, would that also increase free cash flow? Sure it would. Sure it would. So it's going to overstate it. And companies will do this because marking their assets to the market value looks like they have a higher operating income, looks like they have higher free cash flow, and it increases the value of the asset in the open marketplace, the asset being the company. Well, it makes sense. If the fixed assets are worth more, the company's worth more. So it makes sense to us. So now let me come back over here and look at what we've done. Let's assume for a moment that the assets on this company's balance sheet have already been marked to the market. That means that we can then expand our equation here, knowing that tangible assets plus goodwill equals assets. And now we can say tangible assets plus goodwill equals liabilities plus owner's equity. Now we're going to rearrange the equation to solve for goodwill. We know what the assets are. We know what the liabilities are. We know what the owner's equity was. But we don't know what the goodwill is. And the goodwill is what value it embodies greater than the value of the tangible assets it holds. So to calculate this, goodwill is going to be equal to liabilities plus owner's equity minus tangible assets. And in this case, we can plug in the Miragiorana values and we can run the equation, and we can then see that the goodwill for that company is 26.23. What relevance does that have, and who cares? Well, as it turns out, almost all companies would actually have a valuation greater than the value of the assets on the balance sheet. Why would that be?
Because of the premium you're going to pay, or?
Yes, but why would we pay a premium? Why wouldn't I just go out and, instead of buying Malmstrom Enterprises for $300 million, if it's got $200 million of assets on its balance sheet, why don't I just spend $200 million and buy either its assets from it or go out and spend $200 million and replicate its assets. Why would I spend $300 million, Victor?
The value,
No, Megan, go ahead.
the value of their goodwill.
Well, yes, but why is there goodwill? What's it telling us? Think of it like this. The value of a company isn't simply the value of its assets. If it was, we wouldn't have to go through all this valuation stuff we've been spending weeks on, right? It's what we do with the assets to get cash flows that creates its value. Well, it's the assets just sitting there on their own don't do much. It's when we as human beings, decision makers, etc., interact with them that causes them to create cash flow, and that's what creates value. So you can literally think of goodwill as the expansion in value because of the interaction of people and the company's assets. This is not unlike its human capital value. I don't want to go too far down that rabbit hole, but it's not unlike its human capital value.
Yeah. So like, let's say Coca-Cola, would the brand Coca-Cola be included in the goodwill, or is it completely different in the
No,
valuation?
the brand is estimated as goodwill because without people's interactions to the recipe, to the factories, etc., there is no brand, right? And there is no goodwill. Those are going to be synonymous, Martin.
Okay, so like Nike and their slogan, like just do it.
Yep.
The just do it slogan would be included.
Yeah,
like we would the value of the goodwill would reflect the just do it.
Yes, exactly.
Okay.
Very good.
Okay. All right. Thanks.
Okay, so we've covered a fair amount of ground here today. And if it's taking you a couple of minutes to connect to these things, I'm going to encourage you to walk back through these slides and do some of the calculations yourself, look back and forth at the balance sheet, the income statement. You have all this from Marijuana. Again, we'll go through this with another set of numbers perhaps on Wednesday. Any other questions that you might have for me for today?
Yeah, it's not really related to what we just did, but I'm just like for the course essay, I'm just wondering, like, I have a hard time just grabbing all the information and understanding as like if I had to value a company, should I use everything of every models, only one? Should I choose one? Would one be better than another?
Good
like
question.
I'm kind of confused of like how as an investor would you have to do that too, or I don't know, I'm kind of like
So
lost.
Martin, you're only confused because we haven't talked about some of that yet. Okay, remember we have some weeks between now and the end of the term, and so there's going to be things that we will discuss that will become part of that essay. But let me just address that briefly because you're getting to the point where you probably want to understand this. I think that we recognize that our different valuation models brought about fairly similar values for this company, right? So which one do we use? Is it one?
And should we aim for that? Do we want to all the models to show the same numbers?
Well, I think if you try to artificially cause them to show the same number, maybe by choosing a multiple just out of thin air, but that brought them into alignment, or a KU and K tax that just magically brought them into alignment, I think you're doing yourself a disservice. Okay?
Yeah.
But if you find in using 4 different valuation models that you have a price or value disparity of more than about 10%, high to low, then you probably are using one of the models incorrectly, or an input to the model incorrectly, or that model type isn't relevant to that kind of company. We're not going to get to the point in this class to match up model types with companies. If you go on into Finance 409, we'll do that there, but we won't take the time in this class to do it here. But I can tell you that let's assume that this is the range, 149.78 to 146.02. And you're going to say, okay, fine, Rick. Well, what's it going to be? because there's like a $3 million, almost $4 million difference between that, and $4 million is not trivial to most of us. I know it is to Megan, but not me, okay? So what's the number going to be? Well, some of this is going to be an issue of negotiation. So it's fair to say that this is its value range, but since we're not negotiating here, we as analysts are being asked to pinpoint a number. I might take the weighted average, or I might take the average of these values. I might throw out the highest one and take the average of the others. And this is where some of the interpretation and the artistry is going to come into play. Here's what I will tell you straight off the top of my head. I never see a valuation analyst use the APV model. I always see them use a multiple, and I always see them use a discounted cash flow in the form of free cash flow or its equivalent, okay? I almost never see KVD. So if I was the one doing this, I'd say I got a range of 149 and 146, and I'm going to just take the average of those two. And that's going to give me the value. Now let's bring this discussion back to the essay. So the essay says that you want to use one of the models. So you don't have to think about all the other models necessarily. You're going to use one of the models, and you're going to give me a scenario in which you discuss how that model and its inputs might be used in helping make a decision for your company. So let me give you an example of what this might be, okay? Let's assume for a moment that the McJames Enterprises has decided to put together a European manufacturing operation. And it's going to cost about $30 million to put that operation into place. Fair enough? We know it's going to cost us, but what's its value going to be to us? Well, Megan and her senior executives have calculated what additional sales they believe are going to come from that, what costs are going to be associated with those revenues, and have brought that down to some cash flows that are going to be associated with that operation. And because they know the cash flows and because they have some discount rates, they then are able to come up with a value of that new operation. And let's say the value that they calculate is $42 million. If it costs them $30 million to put it into place, and its present value, taking its expected discounted cash flows, let's say I'm using the free cash flow model, if its value is 42 million, that gave us a net present value of $12 million. Of course we're going to spend the $30 million. It doesn't take a rocket scientist to figure that one out, right? If it cost us 30 and was going to give us 30,250,000, well, is that extra $250,000 of economic profit, which is, or net present value, is that worth all the time and the risk that we might be taking? I don't know. That's why Megan is the CEO. She has to make that decision. That's why she makes the big bucks. Okay. Well, you can take this and you can do it on a full firm level, or you can take it and do it on a subsidiary level, or you can just say, well, we're thinking about adding another production line in our existing warehouse, or we're thinking about adding a group inside of the company to help us get to help our marketing, whatever it happens to be. So give me a hypothetical scenario and then show me how using these instruments focused on one of these model forms can help you make decisions as a decision maker based on that scenario. And you're welcome to apply actual numbers to it, which means you're going to have to forecast numbers and such, or if you'd like, you can simply walk me through it theoretically. I don't tell you that you need to apply numbers here, do I? No.
No, I don't think so.
You can approach it completely theoretically. It might be easier for you to give some hypothetical numbers, but that's up to you. And I'm not going to give you a better or worse score because you chose to apply numbers or not. Your score is going to be about how well you did what you did.
Okay. But we only choose one model.
You only choose one.
Okay.
Yep.
All right. Thank you.
Okay, any other questions? Okay, well guys, I appreciate spending the time with you. I hope that you're getting enough out of these sessions like this. Obviously, not all students are in these. We've got a couple of people that are with us that have been completely silent. In fact, I was hoping that somebody of the others was here, but I now know that we've got Peter, who like almost never says anything. In fact, he's only slightly more talkative than Paula, who's also with us, and Fred and Xinjiang and Ada and Mr. Drake Duval. So it's good to have you guys with us today. I hope you're getting enough out of these to make it worth your while. But I'm certain it's going to take you guys also spending a little bit of time going back through and revisiting the PowerPoints and some of the videos and such. Okay? All right. You guys have a great day, and we'll talk to you in a couple days. Oh, by the way, remember that we have Tom Lewis, the former CEO of Ameritrade, TD Ameritrade, will be a guest speaker for us on Wednesday.
On Wednesday?
Yeah,
Okay.
he's a very impressive guy. He's actually on our advisory board for the Gore School of Business. And so I think you'll enjoy listening to him. Okay?
All right.
All right, have a good day. Bye.
Thank you.
Thank
Bye.
you. Bye.